Wei. Can anybody hear me? Are the visuals and audio okay? If you can hear me clearly, please type the numeric 0 in the chat room. Good afternoon, Casters or Gura. Can anybody hear me? If you can hear me, please type the number 0 in the chat room. Good afternoon, Casters or Gura. Can anybody hear me? Can anybody hear me? If you can hear Hello, Matthew and Erica. Please type number 0 in the chat room. Number 0 in the chat room. Okay, since the visuals and audio are okay, I think let's start. Hello, Matthew and Erica. Hello, Matthew and Erica. Welcome to Weebearn, which helps you grow rich. We are a comprehensive money educational platform dedicated to nurture entrepreneurs, investors, and capitalists among secondary school students, cosplayers, and anime lovers. Today is the 10th live streaming in English, so let me introduce our channels. Weebearn literally means an otaku money-making channel, a platform designed to facilitate financial gain. We make otakus great again and make weebs rich again. 毒撚賺錢台. In today's market reading AM Miscellaneous, we're going to read 2 papers or 3. One is from HKDAS, the Hong Kong Digital Asset Society, talking about the recent regulatory development in Hong Kong or about stablecoin and RWA. If you want to get a brief idea about what is RWA, you may take a look at our previous live streaming in Mandarin. We've hosted a brief introduction to RWA, that is real-world asset, in this in our previous live streaming. You may watch it after this live streaming later. First meeting with Erica. Oh, hello, Erica. I think I've seen you in the chat room before. First meeting with Erica. Oh, hello, Erica. I think I've seen you in the chat room before. First meeting with Erica. Oh, hello, Erica. I think I've seen you in the chat room before. I think it's a video because it's recorded. Okay, this is our previous live streaming introducing RWA. And in my opinion, real asset or tokenized real asset precisely is quite a narrative in the current market situation. Alongside with AI agents and stablecoin, is narrative in the current market situation. Alongside with AI agents and the past week's market trends indicated a strong rebound in the crypto market. Bitcoin BTC started around $64,000 and surged to $80,000, closing at approximately let's check the current price now together. It closed around $77,000 the day before, I think. Close around $77,000 before, I think. Master Matthew. I think Matthew is our new audience. Welcome to Weebearn. And Erica says too much echo. So let me turn off the background noises or the echo. Is the audio okay now? I've increased the amplitude threshold for the voice filter for our microphone. If you can hear me clearly, please type the number 1 in the chat room. Ethereum showed even stronger performance, rising from around 19,000 to over 25,000. 1,900 to over 2,500. This suggests capital flow is not only concentrated in BTC but also significantly moving into ETH. ETF flows have been robust, while BTC ETFs seeing inflows totaling approximately 1.62 billion during the period, reaching about 1.92 billion for the week, including the 17th of August. ETH ETF also attracted around 697 million, with ETHA being a primary source of buying. Combined inflows for BTC and ETH ETFs amounted to about $2.6 million, a key driver for breaking previous resistance levels. From a macroeconomic perspective, liquidity expectations improved. Although risks from the Federal Reserve remain, the U.S. Treasury decision to increase buyback sizes for long-term bonds helped lower yields and strengthen inflation hedging assets like gold and BTC. However, Fed meeting minutes indicate concerns about inflation persisting above the 2% target, suggesting that interest rate risks are not fully alleviated. The current rebound is primarily due to improved liquidity expectations and capital inflows, rather than a complete relief from interest rate pressure. The CoinGlass Greed and Fear Index stands at 74 greed, up by 34 points, while the CMC Fear and Greed Index is at 81, extreme greed, up by 41 points. BTC dominance has since increased slightly to 59.96% from the previous 59.29%. And here are the important upcoming macroeconomic events, including the US July core PCE price index year-on-year on 8:26 of August. The US EIA crude oil stocks for the week ending 21st of August, also on 26th of August. At 10:30, and then on the 27th of August, the US initial jobless claims for the week ending the 22nd of August will be announced, and also the US preliminary non-farm payrolls benchmark revision for 2026 will be announced on 10 o'clock on the 28th of August at 10 o'clock. And US August Michigan Consumer Sentiment Index will also be announced at that time. The recent surge of over around 20,000 points in BTC has shattered the stagnant market conditions of the last 3 months, hinting at the early stages of a bull market. In this analysis, we'll outline the trading framework or system for the upcoming market cycle, or you may consider it as a super cycle, focusing on reviewing and identifying triggered and untriggered cycle bottom signals that is driven by some on-chain indicators or technical indicators, examining large-scale trend structures and potential paths, and also sharing our community strategy for cycle trader or trend trader. The bearish market bottom signals are emerging, yet confidence remains cautious. The current cycle exhibits significant differences from previous ones due to changes in the market structure and participant dynamics. If we assume the bear market has concluded and the bull market is underway, several cycle level bottom signals have appeared over the past 3 months or the past quarter, including PSIP dropping below 50% on the 8th of June, AVIV heatmap entering a blue zone on the 30th of June, and a shift in the 1-year to 3-year holder ratio on the 18th of August. These signals together are undeniable indicators of a cycle level bottom, but we as professional traders, we should seek for more conditions or more confluence for convergence, such as clearing the liquidity map, the concentrated liquidity at around $60,000 or prices falling into a deep bear valuation zone according to the AVIV map. Although the 4-year cycle is fading, moving towards shorter bull and bear cycles, we believe that there's still a certain impact driven by the 4-year halving cycle. Although the incentive or the potential growth may not be as much as that in the previous 3 bullish cycle. For example, in the previous bullish cycle, you may earn 100 times, 1,000 times, or a few times in the last bullish cycle. But in this bullish cycle, you may only earn 2 or 3 times. 2 or 3 times of your initial principal capital. From a trend trading perspective, the classical 1, 2, 3 rule, according to the Dow theory, is used to assess trend reversals. The current BTC trend structure requires breaking the lower high at around $83,000 to indicate the first condition of the 1, 2, 3 rule, that is a breakout of the trend line liquidity. Although not fully satisfying the rule, achieving this would significantly increase the likelihood of a trend reversal. Looking ahead whether BTC directly breaks through 83,000 or not, attention should be on price behavior during pullbacks or around the resistance level or supply zone at around 81 to 83,000 US dollars. A market that only rises without falling is unrealistic, hence identifying when and how pullbacks occur is crucial and also essential for us to pursue or purchase more Bitcoin. An ideal scenario would involve a slowing upward trend, horizontal consolidation, and a short-term downward stop hunt to form a large-scale higher low before resuming an upward trend to create new higher high. The formation of a large-scale higher low presents an ideal entry or additional position window. For additional context, if the past 3 months of consolidation between 58 to 67,000 US dollars are viewed as an accumulation zone according to the AMD theory of technical analysis or smart money concept before rising. Revisiting this area could offer an attractive entry opportunity. However, if BTC forms a large-scale high low without reaching this zone, it may indicate the pullback has already ended. BTC remained in the narrow range for over a month and a half without clearing the 61,000 trendline liquidity. Ultimately, price action was catalyzed by a massive accumulation zone, prompting to fully commit remaining spot positions. So if you still haven't purchased Bitcoin, I myself, I would personally plan to enter under two circumstances. The first is that the appearance of a large-scale high low and also a failed reversal with prices falling between 58,000 US dollars into a deep bear valuation zone together with confluence of other on-chain technical indicators. While BTC's cycle characteristics may be diminishing over time due to structural changes in market participants and reduced halving effects on supply-demand dynamics, its appeal lies in its rapid market pace and high volatility. As BTC matures, we should accept its inevitable shift towards decreasing volatility and also decreasing potential income. The perspective remains consistent. That is, BTC is likely moving away from the 4-year cycle into a new rhythm of a shorter and also less volatile bull and bear cycles, characterized by decreasing volatility and reliance on some new narratives and market liquidity. If you have earned a huge income in the previous bull cycle, you may be aware of many earning opportunities, including the metaverse, the meme coins, NFTs, inscriptions, runestones, and so on. However, in the recent years, most of the capital shifted towards TradFi, like commodities and then AI agents or stocks related to AI, and there's not much capital left within on-chain, and also there are fewer and fewer narratives under the current regulatory circumstances or regime. ETFs, particularly thematic ones, are experiencing significant growth driven by low fees, ease of access, and increased retail participation. The themes dominating the ETF landscape have shifted from clean energy and healthcare in 2020 to AI, nuclear, and space by 2026, reflecting a broader focus on capital-intensive industries, or focusing on companies that can withstand high capital expenditures. Data centers are highlighted as key economic drivers, especially in regions where they constitute a large proportion of non-residential construction. Even here in Hong Kong, the Hong Kong government is also pushing towards building more data centers. In Kwai Chung, there's a data center where you may get quicker access to Chinese H stocks. These data centers offer substantial employment opportunities and wage premiums, particularly in skilled trades, making them economically beneficial despite local opposition. Ride-sharing costs have increased, notably for Uber due to rising platform fees. This has benefited both the companies and drivers, with driver pay reaching new highs. The gig economy is also expanding, with social commerce emerging as the fastest growing segment of stocks, likely due to shifts in media consumption and technological advancements. AI adoption is uneven across industries, with power users significantly outpacing others in token output and tool sophistication. Legal sectors have notably increased their use of advanced AI tools. Agents are becoming prominent, consuming more tokens than humans and potentially reducing demand for traditional automation tools. Overall, these trends indicate a dynamic shift in market priorities and technological integration across various sectors, with significant implications for future economic and employment landscapes. Traders are returning to Ethereum as their primary holding, instilling confidence in the market. By TVL, the ETH is still the largest blockchain and the largest altcoin on. This resurgence in trader activity has pivoted towards altcoins, particularly those complying with the US regulations, generating real revenue, and associated with decentralized finance such as Hype, Pump, and INA. Notably, INA, Pendle, AVE, and Morpho are spearheading a revival in the DeFi sector. On-chain activities are focusing on the Robinhood ecosystem. This is also worth noticing. I and also some industry peers within the educational industry also think that the Robinhood ecosystem is quite promising in the current era, focusing on RWA or stablecoin. Mega ETH and Monarch were set to host a silicon conference in October. SocialFi is experiencing a resurgence as the market warms up. The new platform, CommonsMate, is gaining traction by using Ethos credit scores. Let me type this SocialFi project in the chat room, and you may take a look at that. Once again, these are non-financial advice, NFA. You should always be a responsible person. That is a very, very basic more principle to bear responsibilities for our own money-making decision-making. So only people who take responsibility in their business decision or finance decisions will become successful. While those who always blame the KOLs or blame the media solely for their losses, they will never be successful, since they are not in charge of their own business decisions or money-making decision. That's just some rich mindset borrowed from the book The Millionaire Fastlane, and if you haven't read the book, we recommend you to watch our previous reading Miscellaneous in Canada's main channel in Weebearn. Within 2 days, only the top 1,000 participants qualify for the Commons made airdrops, sparking a FOMO in the market. The platform highlights virtuals Solana differing from the ecosystem of Base. High-scoring accounts have emerged in the Chinese community, presenting an opportunity for players to engage. Recently, the airdrop results have led to disappointment. Thousands of key opinion leaders engaged in mutual vouching to boost scores over 3 days, but only 0.5% of rewards were distributed to the top 1,000 participants, each receiving approximately only $15 to $25, falling short of expectations. The community has criticized this model for benefiting influencer circles on crypto Twitter while failing to attract genuine buying interest. The initial excitement has quickly turned into disappointment, with sentiments of too much hype leads to failure gaining traction. And let's talk about strategy, formerly MicroStrategy. Direct beneficiary of BTC hits when BTC hits the $80,000. As BTC approaching $80,000 this week, BTC is nearing $80,000, marking the largest rebound in 2026. MSTR as a pure BTC proxy directly benefits alongside Coin, CLCL, Circle, Mara, and Robinhood, all achieving their strongest single-week performance in months or years. Sorry for the background voices. On the 19th of August, financing MSTR raised $333.7 million through equity issuance, increasing its exposure to BTC price fluctuations, demonstrating an unchanged strategy of accumulating Bitcoin. The convergence of Treasury liquidity, SEC regulations, and presidential pressure for clarity has revealed the entire crypto sector. On the 19th of August, the Treasury doubled long-term bond buybacks to lower yields, improving the funding environment for overvalued crypto stocks. BTC stabilized above $68,000 and subsequently broke through 30,000 and 35,000. The core value of the strongest week in crypto stocks is this week, where BTC at 77,000 and ETH at around 2,500 have redefined the Q4 price fall. Due to its leverage characteristics, MSTR has become one of the most significant gainers among crypto value stocks. Pure BTC miners participated in the rebound, but AI transform miners declined due to profit taking, indicating a clear fund flows towards pure BTC exposure assets. The ability of BTC to maintain levels between 77,000 to 80,000 is crucial for stock price movement. And getting back to Robinhood, HOOD, known as a gateway for retail cryptocurrency trading, has experienced a notable increase in its stock price, showing an 11.1% rise over the past week. On the 21st of August, the stock surged by 12.4%, leading the fintech sector driven by three key catalysts: support analyst ratings, expansion in the private equity market, and strong momentum in international crypto operation. The company benefits from dual narratives. The first is a resurgence in crypto trading volumes and favorable regulatory conditions, making it a prime target for investors interested in these themes. The second one is the international crypto operations and a supportive regulatory environment have bolstered overall market sentiment, as reflected in Robinhood's robust revenue and net income figures. On the 19th of August, the stock rose alongside its peers due to factors such as increased long-term treasury buybacks, which lower yields, and Bitcoin stabilizing over $68,000, influencing crypto-sensitive stocks positively. This week witnessed significant events, including a broad rally in crypto stocks on the 21st of August, with HOOD leading the charge with a 12.98% gain. Other notable performances include Gemini increased by 10%, Coinbase increased by 9.6%, and Circle increased by 9.25%, indicating a renewed interest in the crypto sector. Bitcoin's weekly surge of over 20%, reaching 75,897 at that intraday, marked its largest weekly gain in over 2 years, while XRP also rose by 18%, nearing $1.2, reflecting improved risk appetite and capital flows. Looking ahead, Robinhood's expansion into the private equity market is expected to drive user and revenue growth, with increased penetration in the UK market anticipated to add millions of new accounts. Additionally, the upcoming vote on the Clarity Act on the 15th of September could directly impact crypto trading volumes and regulatory certainty. Next is the leader in stablecoins, Circle Internet Group. CRCL has experienced a notable increase of 20.42% over the past 5 days. A recent favorable development includes the SEC's new framework, which distinctly categorized payment stablecoins, has reduced regulatory risk for Circle's issuance model. On the 19th of August, Circle's market share surged as reports indicated it was capturing stablecoins issuance market share from Tether, with USDC circulation rising to 73.3 billion, marking a 10% jump in a day. On the 21st of August, Circle acquired IBM's blockchain patent portfolio, securing over 680 patent families and nearly 1,000 approved patents, thereby strengthening its technological moat as demand for USDC grows within the Arc blockchain ecosystem. Analyst price targets vary but lean positive. TD Cowen increased its target to $87 from $82 on the 17th of August, while Seaport Research lowered its target to 100 from 145 on the same day. The current valuation battleground lies between $87 and $100. Between the 18th of August and the 22nd of August, a collective surge in crypto stocks occurred, driven by Treasury liquidity, SEC rulemaking, and presidential pressure on Clarity, resulting in a short squeeze of approximately $2.75 billion and a revaluation of the entire sector. Circle exhibits high beta characteristics, closely monitoring BTC movements. This week, BTC's breakthroughs at 70,000 and 75,000 were pivotal to the stock's explosive performance. Looking ahead, the procedural vote on the Clarity Act on the 15th of September stands as a significant legislative catalyst on the calendar. The next valuation repricing will require either Q3 revenue exceeding expectations or clear terms regarding stablecoin licensing. This week is crucial for investors to pay close attention to the significant event of the US Treasury interviewing in the bond market by increasing long-term bond buybacks. This intervention is a clear signal that we need to reassess our understanding of the current macroeconomic landscape. While we typically focus on the AI industry chain, we should always place a great emphasis on macroeconomics, dedicating substantial effort to monitoring its development. However, we may not write about macroeconomic analysis frequently because the broader economic trends are akin to wind direction. They do not shift every moment. It is sufficient to observe quietly each day, ensuring that the overall direction remains on course without any fundamental reversals. In times of stable economic trends, it is more prudent to concentrate on micro-level stock and industry research. For us, Weebearn, both macro and micro perspectives are equally important. But we think that macro is slightly more important than micro, or macro is generally more important than micro. If investing is likened to selling individual stocks and industries on your vessel, while economics is the wind direction. If the wind direction at sea charges subtly, failing to adjust your sails can hinder your progress or even lead you off course. We do not need to predict storms every day, but when there is a structural shift in wind direction, it is imperative to stop and recalibrate our sails. This week is undoubtedly such a moment. And here we should focus solely on the significant macroeconomic issue and provide analysis regarding what's exactly happening in the bond market. Why does the Treasury need to intervene now? What is the underlying logic behind this intervention? And most importantly, how will it impact the market? To aid in understanding this topic, we have included some extended reference material in our Discord community, and you may take a look at it. The US Treasury Department announced on the 19th of August that it will double the buyback scale of long-term government bonds, increasing it from $2 billion to at least $4 billion per transaction, focusing on bonds with maturities of 10 to 30 years. Okay, why is the long-term bond interest rate so important? The yield on 30-year US Treasury bonds directly affects the mortgage rate for 30-year loans. The long-term borrowing cost for corporations and the annual interest rate payments the US government must take. If mortgage rates rise, households face higher monthly burdens. If corporate financing costs increase, business expansion and hiring may slow down. Additionally, if government interest expenses surge, it can crowd out other budgetary allocations. These factors directly impact household cash flow, and the real cost of economic activities. Therefore, rising long-term bond rates influence various sectors, necessitating government efforts to control them. The Treasury's move is not indicative of quantitative easing, QE, or money printing. Instead, the Treasury is using a strategy of issuing more short-term bonds to buy back long-term ones from the market. This reduces the supply of long-term bonds while increasing short-term ones, thereby pushing down long-term interest rates without significantly altering total money supply. This approach resembles the Federal Reserve's past Operation Twist, with a key difference being that this time is initiated by the Treasury Department. In the US financial system, two main focuses regulate interest rates: the Federal Reserve and the Treasury Department. The Federal Reserve controls the quantity of money and cost of borrowing. It manages how much money circulates in the market by adjusting benchmark interest rates to influence borrowing costs, or by using QE money printing and QT withdrawing funds to alter the total money supply. You may also check our previous video to take a look at how the interest rates control the business cycle. The Treasury Department determines which types of bonds to issue and when they need to be repaid. While it cannot print money, it can choose to sell either long-term bonds to be repaid in 30 years or short-term bonds due in 3 months. While altering the supply and demand bonds of different bond maturities, it indirectly guides market pricing. In this instance, the Treasury Department is taking proactive measures. Thus, this is not money printing or QE. It is simply an adjustment of the interest rate curve. The operation in question, involving the buyback of 30-year Treasury bond, did not sustain its impact beyond 2 days due to several underlying factors. Initially, there was a decline in yields to approximately 5.19% on the day of the announcement, but it quickly rebounds to 5.23% to 5.26% the following day, effectively negating the initial drop. The buyback amounted to around 14 billion, which is negligible compared to the over 30 trillion US US Treasury market, representing only a few weeks' worth of trading volume. The initial decline was driven by market surprise at the government's intervention. However, in a low-activity summer market, such unexpected news can force short sellers to cover their position. Once the market had time to digest the news, they realized that the actual buying amount was too small to have a lasting effect, leading to a swift reversal of the yield drop. Furthermore, the impact of policy interventions tends to diminish over time. The first intervention might surprise the market, but subsequent actions require more substantial measures to have a similar effect. Despite Treasury Secretary Scott Bessent's public statement suggesting that the buyback could be expanded to create a sense of impending large actions, this could eventually lead to market skepticism if it's not substantiated. The real challenge facing long-term US Treasuries is rooted in both supply and demand issues. On the supply side, tech giants like Amazon, Alphabet, Meta, and Oracle are issuing significant amounts of long-term corporate bonds, which compete directly with treasuries for the same pool of investors, such as pension funds and insurance companies. This year alone, these companies are expected to issue around $250 billion in corporate bonds. On the demand side, foreign central banks and governments have been reducing their treasury holdings. For example, China's holdings have adopted to their lowest since 2008 on September. This shift is partly due to countries needing USD for currency interventions, as seen with Japan's recent actions to support the yen. The marginal buyers of long-term treasuries are now more price-sensitive private investors rather than foreign central banks, which were less concerned about yield levels due to their focus on foreign exchange reserves. These new buyers, including pension funds and hedge funds, demand adequate risk comparison and will require higher yields if they deem the term premium insufficient. Therefore, as much as tech companies continue issuing large amounts of debt and foreign central banks reduce their willingness to purchase treasuries, long-term interest rates will face upward pressure that cannot be mitigated by relatively small-scale pullbacks. Here we discuss the potential negative consequences of a recent financial decision involving the US Treasury's debt management strategy. We outline several side effects that could rise from this decision. The first is the damage to long-standing credibility. The US Treasury has maintained a consistent and predictable debt issuance policy for decades, which was built investor trust. The recent charges, however, could undermine this trust, as investors might perceive these alterations as a deviation from established norms. This unpredictability could lead to increased term premiums, which are essentially risk compensation for lending money over extended paths. The second one is the electron timing clauses. The timing of the expanded buyback program coincides with the US midterm election period, which could be seen as politically motivated. By temporarily lowering long-term interest rates, the government might aim to increase voter concerns about mortgage costs and counter opposition criticism regarding budget constraints. Such actions could foster skepticism among investors and elevate term premiums, so they might suspect political interference in financial markets. A significant portion of US Treasury is set to mature within a year, and the average maturity platform or period is relatively short for a large economy. By replacing the long-term debt with short-term debt, the government might have on current interest expenses, but at the cost of increased future risk. If short-term interest rates rise or demand for short-term debt Despite Treasury Secretary Scott Bessent's public statements suggesting that the bank buyback could be expanded to create a sense of impending large actions, this could eventually lead to market skepticism if not substantiated. The real challenge facing long-term US Treasuries is rooted in both supply and demand issues. On the supply side, tech giants like Amazon, Alphabet, Meta, and Oracle are issuing significant amounts of long-term corporate bonds, which compete directly with treasuries for the same pool of investors such as pension funds and insurance companies. This year alone, these companies are expected to issue around $250 billion in corporate bonds. On the demand side, foreign central banks and governments have been reducing their treasury holdings. For example, China's holdings have dropped to their lowest since 2008 in September, and Japan has also reduced its holdings. This shift is partly due to countries needing USD for currency interventions, as seen with Japan's recent actions to protect the yen. The marginal buyers of long-term treasuries are now more price-sensitive private investors rather than foreign central banks, which were less concerned about yield levels due to their focus on foreign exchange reserves. These new buyers, including pension funds and hedge funds, demand adequate risk convention and will require high yields if they deem the term The timing of the expanded buyback program coincides with the US midterm election period, which could be seen as politically motivated. By temporarily lowering long-term interest rates, the government might aim to ease voter concerns about mortgage costs and counter opposition criticism regarding budget constraints. Such actions could foster skepticism among investors and elevate term premiums, as they might suspect political interference in financial markets. A significant portion of US Treasury debt is set to mature within a year, and the average maturity period is relatively short for a large economy. By replacing long-term debt with short-term debt, the government might save on current interest expenses, but at the cost of increased future risk. If long-term interest rates have rise or demand for mistakes where low interest debt was replaced by high interest debt as condition charge. Overall, the text warns that these decisions could lead to higher long-term interest rates and increased financial instability, while also complicating the future debt management efforts. The text discusses the dynamics between the Federal Reserve (FED) and the US Treasury in terms of interest rate policies and market expectations. Kevin Walsh, a prominent figure in the FED, has experienced a preference for allowing the market to determine long-term interest rates rather than having them suppressed by policy authorities. This stands contrast with the Treasury's objective to lower long-term rates. Walsh's approach suggests a belief in the market's ability to self-regulate and adjust interest rates based on its own assessments, rather than relying to The U.S. Treasury has maintained a consistent and predictable debt issuance policy for decades, which has built investor trust. The recent years' changes, however, could undermine this trust as investors might perceive these. The timing of the expanded buyback program coincides with the U.S. midterm election period, which you could see as politically motivated. By temporarily lowering the long-term interest rates, the government might aim to ease other The government might aim to ease voter concerns about mortgage costs and counter opposition criticism regarding budget constraints. Such actions could foster skepticism among investors and elevate term premiums, as they might suspect political interference in financial markets. A significant portion of U.S. Treasury debt is set to mature within a year, and the average maturity period is relatively short for a large economy. By replacing long-term debt with short-term debt, the government might save on current interest expenses, but at the cost of increased future risk. If short-term interest rates rise or demand for short-term debt wanes, the government's interest expenses could surge. This mirrors past mistakes where low-interest debt was replaced by high-interest debt as conditions change. Overall, we warn that these decisions could lead to a higher long-term interest rates and increased financial instability, while also complicating future debt management efforts. And let's discuss the dynamics between the Federal Reserve Fed and the U.S. Treasury in terms of interest rate policies and market expectations. Kevin Walsh, a prominent figure in the Fed, has expressed a preference for allowing the market to determine long-term interest rates rather than having them suppressed by policy authorities. This stance contrasts with the Treasury's objective to lower long-term rates. Walsh's approach suggests a belief in the market's ability to self-regulate and adjust interest rates based on its own assessments, rather than relying heavily on central bank guidance. He supports reducing the Fed's balance sheet, which could naturally lead to upward pressure on long-term rates, conflicting with the Treasury goals. In the current political climate, where there is pressure from the White House to lower rates, Walsh appears to be navigating a complex situation. He aims to maintain short-term rates while allowing long-term rates to rise, using higher long-term borrowing costs to temper the economy and curb inflation. The Fed faces challenges in line with the Treasury's goals because doing so could undermine its credibility and independence. If the market perceives that the Fed is accommodating government demands, it could destabilize inflation expectations and lead to higher long-term rates due to increased inflation risk premiums. The underlying concern is the potential for fiscal dominance, where government financing needs overshadow the central bank's ability to independently manage monetary policy. According to inflation and employment mandates, while this scenario has not yet materialized, it is something the Fed seeks to prevent. The ongoing intervention by the Treasury and long-term rates could complicate Walsh's efforts to maintain a clear distinction between fiscal and monetary policy. The influence on the stock market does not necessarily indicate a full-scale bear market, but rather suggests that capital will become extremely selective. The traditional belief is that high interest rates inevitably form the slow market, but in capital allocation is not that straightforward. Firstly, the volatility of long-term U.S. Treasury bonds and high policy uncertainty have significantly reduced the attractiveness of traditional buy bonds for safety strategies. Stocks relying solely on narratives, investors will see their valuation premiums continuous, compressed in an environment where the cost of capital remains. Companies with high-quality operations, possessing strong balance sheets, pricing power, and the ability to convert these into free cash flow will continue to attract funds. There are several potential paths to address the issue of long-term interest rates, each with its own challenges. The first one is Treasury debt management. The Treasury debt management continues managing debt or the bond issuance. However, this does not change the overall debt volume and has diminishing returns. Without reducing the scale of bond issuance, yields will likely rebound quickly. The second point is that the Federal Reserve could intervene by resuming bond purchases or cutting interest rates. However, doing so while inflation remains high is akin to simultaneously accelerating and breaking. And breaking actually means unbreak. Government debt reduction plan. We implement a credible long-term debt reduction strategy, which is the only fundamental solution to lower the term premium. To happen below elections due to the need for budget cuts and fatigue. Let us take a 1 minute break and let me grab a coffee. Okay, let's come back. There are some potential negative consequences of the recent financial decision involving the US Treasury's debt management strategy. Here are several side effects that could rise from this decision. The first is the damage to long-standing credibility. The US Treasury has maintained a consistent and predictable debt issuance policy for decades, which has built investors' trust. The recent changes, however, could undermine this trust, as investors might perceive these alterations as a deviation from established norms. This unpredictability could lead to increased term premiums, which are essentially risk compensations for lending money over extended periods. The second is the election timing concerns. The timing of the expanded buyback program coincides with the US midterm election period, which could be seen as politically motivated. By temporarily lowering long-term interest rates, the government might aim to ease voter concerns about mortgage costs and counter opposition criticism regarding budget constraints. Such actions could foster skepticism among investors and elevate term premiums, as they might suspect political interference in financial markets. A significant portion of US Treasury debt is set to mature within a year, and the average maturity period is relatively short for a large economy. By replacing long-term debt with short-term debt, the government might save on current interest expenses but at a cost of increased future risk. Here are the dynamics between the Federal Reserve and the US Treasury in terms of interest rate policies and market expectations. Kevin Walsh, a prominent figure in the Fed, had expressed a preference for allowing the market to determine long-term interest rates rather than having them suppressed by policy authorities. This stance contrasts with the Treasury's objective to lower long-term rates. Walsh's approach suggests a belief in the market's ability to self-regulate and adjust interest rates based on its own assessments rather than relying heavily on central bank guidance. He supports reducing the Fed's balance sheet, which could naturally lead to upward pressure on long-term rates, conflicting with the Treasury's goals. In the current political climate, where there is pressure from the White House to lower rates, Walsh appears to be navigating a complex situation. He aims to maintain short-term rates while allowing long-term rates to rise, using higher long-term borrowing costs to temper the economy and curb inflation. The Fed faces challenges in aligning with the Treasury's goals because doing so could undermine its credibility and independence. If the market perceives the Fed is accommodating government demands, it could destabilize inflation expectations and lead to higher long-term rates due to increased inflation risk premiums. The underlying concern is the potential for fiscal dominance, where government financing needs overshadow the central bank's ability to independently manage monetary policy according to inflation and employment mandates. While this scenario has not yet materialized, it is something the Fed seeks to prevent. The ongoing intervention by the Treasury in long-term rates could complicate Walsh's efforts to maintain a clear distinction between fiscal and monetary policy. The influence on the stock market does not necessarily indicate a full-scale bearish market, but rather suggests that capital will become extremely selective. The traditional belief is that high interest rates inevitably harm the stock market, but in actual capital allocation, it is not that straightforward. Firstly, the volatility of long-term US Treasury bonds and high policy uncertainty have significantly reduced the attractiveness of traditional buy bonds for safety strategies. When long-term bonds are no longer a risk-free haven, large institutional funds still need to seek returns, and the stock market remains one of the few asset classes that can combat long-term inflation and debt dilution. Secondly, the profit growth of quality companies remains solid. Therefore, the market will not completely withdraw from stocks, but will instead conduct stringent flight to quality. Stocks relying solely on narratives and visions will see their valuation premiums continuously compressed in an environment where the cost of capital remains high. Companies with high-quality operations, possessing strong balance sheets, pricing power, and the ability to convert these into free cash flow will continue to attract funds flowing from the bond market and lower-quality stocks. Each intervention by the Treasury that leads to a valuation rebound may not evolve into a broad bull market. It will act as a catalyst for capital to concentrate on a select few high-quality leaders. We outline three potential paths to address the issue of long-term interest rates, each with its own challenges. The first is the Federal Reserve's involvement. The Federal Reserve could intervene by resuming bond purchases or cutting interest rates. However, doing so while inflation remains high is akin to simultaneously accelerating and breaking, risking the collapse of central bank credibility. The second one is Treasury's debt management. The Treasury's Department continues managing debt through buybacks and adjusting bond issuance. However, this does not change the overall debt volume and has diminishing returns. Without reducing the scale of bond issuance, yields will likely rebound quickly. And the third approach is the government debt reduction plan. Implementing a credible long-term debt reduction strategy is the only fundamental solution to lower the term premium. Yet politically, it is unlikely to happen before elections due to the need for budget cuts and deficit reduction. The most probable scenario is the second path, while the first path occurring would be the worst-case scenario. Upcoming key events worth noticing include on 28th of August, Fed Chair Walsh's speech will be closely watched for its stance on long-term rates and potential cooperation with the Treasury. On the 4th of November, the quarterly refinancing announcement. The Treasury's quarterly refinancing announcement regarding bond issuance will indicate whether there is a substantive supply-side change or if temporary measures are in place for electoral purposes. Over the past 15 years, global investors have relied on the Federal Reserve to stabilize long-term interest rates. However, with the current situation where the Treasury lacks capability, the Fed lacks willingness, and fiscal consolidation is distant, maintaining high long-term rates may become the norm. The recent developments in the political and financial arenas have stirred significant interest and concern. In the Senate, Majority Leader Thune has filed a cloture motion to end debate before the recess, aiming for procedural vote on the 15th of September. This requires 60 votes to overcome the filibuster threshold. But with only 53 Republican seats, at least 7 Democrats would need to cross party lines. The primary deadlock remains around the conflict of interest clause, with Democrats demanding that Trump divest from encrypted assets, yet the White House has not responded to compromise proposals. A crowded September agenda and looming midterm elections are further eroding market confidence. As reflected in Polymarket's prediction market, where the probability of signing within the year has plummeted to 19% from a peak of 82% in May. In the financial markets, Bitcoin has continued its robust rebound, reaching a high of $80,000, the highest since May, with a weekly surge of over 22% and nearly a 20% increase per month. The rise is attributed to the return of spot ETF buying, with a net inflow of approximately 1.9 billion weekly. Short squeezes in derivatives and a cooling August CPI reducing rate hike symposium and Walsh's first speech as chairman. According to Polymarket, there is a 96% chance Bitcoin will reach $80,000 within the month, a 57% chance of hitting 82,500, but only a 32% chance of breaking 85,000. On another front, the US Treasury is contemplating utilizing its nearly $1 trillion general account TGA to fund its recently announced plans to increase government bond purchases. This move could provide significant leverage to influence long-term bond yields. The Treasury surprised markets by announcing it would double buybacks of the Sun securities on the long end from $2 billion to at least $4 billion. Treasury Secretary Scott Bessent indicated these operations could exceed the new minimum. While most assumed funding would come from selling short-term bills, using the TGA could alter this perception. The TGA serves as a government checking account held at the Federal Reserve and is already funded with existing tax collection. The Treasury's decision has faced skepticism from market analysts about its effectiveness and resource limitation. However, using the TGA might mitigate these concerns and limit reliance on the Federal Reserve's assistance. The Treasury officials emphasized that no changes have been made to official auction schedules, despite criticisms of unpredictably following their surprise movements. Surprise announcement. Treasury Secretary Bessent expressed intentions to focus the market on fundamentals rather than headlines during a thin market period, and anticipates progress in deficit reduction with the return of tariff revenue after court-mandated refunds are replaced by new tariffs. Top officials are expected to meet soon to devise plans for fiscal improvement. Okay, let's start going through the evolution and expansion, navigating Hong Kong's virtual asset regime and the 2026 regulatory perimeter. This paper provides a comprehensive synthesis of the evolving regulatory framework for virtual assets (VAs) in Hong Kong, detailing the transition from an uplift-based supervisory model to a mature, standalone statutory regime scheduled for full integration by 2026. The paper serves as an industry roadmap for understanding how Hong Kong reconciles traditional financial principles with the technical nuances of blockchain-based finance. The primary methodology employed by Hong Kong regulators, that is SFC, HKMA mainly, is activity-based regulation (ABR) rather than creating a blanket license for crypto firms. Regulators evaluate the underlying economic function of the entity. The guiding principle is same activity, same risk, same regulation. The regulatory approach is structured through a layered assessment of risk profiles. Substance over-label. Regulators ignore internal business descriptors, like tech platforms, to evaluate whether a firm platform's functions, such as brokerage, discretionary asset management, payment facilitation, or custody. Analogous to the duck rule in the US. Risk mapping. Firms are assessed assessed against specific risk categories, including market risk, there's the volatility and price discovery, operational or custodial risk, including private key management, cybersecurity, and wallet resilience, and then financial integrity, AML or CFT compliance, and sanction monitoring. And finally, systematic risk, including stablecoin redemption parity and liquidity requirements. The paper delineates a two-stage evolution. Stage 1 is the uplift model. Initially, authorities brought VAs under the perimeter by attaching terms and conditions and circular-based requirements to existing securities and futures ordinance (SFO) licenses, types 1, 4, and 9. Now on stage 2, standalone statutory regimes. The current shift replaces these modifications with dedicated frameworks under the Anti-Money Laundering and Counter-Terrorist Financing Ordinance (AMLO). Key regulatory components include the VA dealing license captures exchanges, OTC desks, and transaction arranging services, necessitating stricter conduct standards and domestic custody. VA custody license, a dedicated regime imposing high capital requirements like paid-up capital of 10 million Hong Kong dollars and liquid capital of 3 million Hong Kong dollars to mitigate the risk of private key loss or unauthorized transfer. Then is the stablecoin issuer regime governed by the HKMA. This focuses on fiat reference stablecoins (FRS). Licensed issuers must maintain a one-to-one redemption mechanism and meet minimum paid-up share capital thresholds. Paid-up capital is greater than or equal to 25 million Hong Kong dollars. The paper highlights the institutionalization of the ecosystem through initiatives like Project Ensemble, which explores the integration of tokenized deposits and money market funds into the traditional banking infrastructure. This transition aims to move digital finance beyond speculative retail trading toward institutional-grade settlement. Ultimately, the report concludes that Hong Kong is systematically bridging the gap between legacy finance and digital assets. By mandating that dealers and managers utilize SFC-regulated local custodians, the regulator is actively localizing the VA value chain, ensuring that the custody ecosystem remains compliant with Hong Kong's rigorous AML and operational safeguards. Hong Kong's approach to financial regulation and by extension its virtual asset VA regime is defined by practical substance over form philosophy. Rather than creating a single catch-all crypto license, Hong Kong applies existing regulatory principles to new technologies. The regulatory landscape for digital assets in Hong Kong is primarily bifurcated between the Securities and Futures Commission (SFC) and the Hong Kong Monetary Authority (HKMA), depending on the nature of the financial activity. Here is the breakdown of their respective roles. The primary focus of the SFC is to govern activities related to securities, futures, and investment products that make us grow rich. Its oversight covers virtual asset trading platforms, intermediaries like brokers or dealers, investment advisory, and asset management. When an entity offers trading assets, investment advice, or portfolio management, the SFC focuses on suitability, risk disclosure, conflict of interest management, and ensuring that client assets are handled securely. The SFC regulates VA-related investment vehicles, such as Bitcoin and Ethereum spot or futures ETFs, ensuring that managers meet strict competence requirements and authorization protocols before public offerings. The primary focus of the HKMA is responsible for the banking system, monetary stability, and payment infrastructure. It takes the lead when digital assets function as money-like instruments, such as stablecoins, tokenized deposits, or settlement assets. As stablecoins and tokenized money involve risks to financial stability, liquidity, and payment reliability, the HKMA applies a framework that mimics traditional banking and infrastructure oversight rather than investment product regulation. The HKMA also oversees institutional pilots like Project Ensemble, focusing on real-value transactions involving tokenized money and assets to support the underlying financial ecosystem, rather than speculative retail trading. Here's a detailed breakdown of the HKMA's involvement in digital finance as described in this paper. The HKMA is the guardian of Hong Kong's banking system, monetary stability, and payment infra. Its oversight ensures that any digital asset adoption does not compromise the broader stability of the local currency or the reliability of financial transactions. The HKMA's involvement is triggered when a digital asset ceases to be a speculative investment and starts functioning as a medium of exchange or a store of value. This is the primary reason the HKMA oversees stablecoins, fiat reference stablecoins. The HKMA is actively fostering institutional-grade digital infrastructure, specifically through initiatives like Project Ensemble. This project is a live pilot focusing on tokenized deposits, digitizing bank deposits for faster settlement, tokenized money market funds, bringing traditional fund structures onto blockchain rails, real value transactions, creating a secure, regulated environment where institutional digital assets can be settled efficiently. When digital assets are traded, advised on, or managed as investment products like securities or futures, SFC that is the responsibility for SFC or the job for SFC. Then is the HKEX, SCHK, and other regulators. HKEX and the Stock Exchange of Hong Kong are less central to the current virtual asset licensing discussion, but they may also become more relevant since tokenization of rural assets or especially stocks develop. Unlike the Securities and Futures Commission SFC and the Hong Kong Monetary Authority HKMA, the HKEX and the Stock Exchange of Hong Kong SCHK are not the primary regulators for the current wave of virtual asset licensing. Their influence is currently limited, since most pure crypto asset activities like trading and custody fall under the SFC's direct oversight. The intersection of tokenization is when their significance is expected to grow alongside the tokenization of traditional finance. As traditional securities, bonds, or investment funds are issued or represented on blockchain rails, the rules governing listed products and public market infrastructure, which the SCHK oversees, will become essential. The HKDAS and SCHK act as the gatekeepers for publicly traded products, such as exchange-traded funds (ETFs) that hold virtual assets. Tokenized securities, where a financial security like a bond or equity is tokenized and requires a regulated venue for secondary market trading, and disclosure standards, ensuring that issuers of tokenized products meet the same rigorous transparency and reporting standards as traditional listed companies. Entities like the Insurance Authority and the Mandatory Provident Fund Schemes Authority are mentioned as being peripheral to the current discussions. While they play a critical role in the broader financial system, their involvement in the digital asset space is currently limited to specific scenarios, such as when issuers seek coverage for crypto custody risk or when pension funds contemplate future exposure to tokenized investment assets. Hong Kong does not issue a single crypto license. Instead, it follows a principle where the license is tied to the financial function performed. Regardless of the underlying technology, if a firm performs a regulated activity, it shall obtain the corresponding license. The uplift model. Early in the development of the virtual asset VA's regime, the Securities and Futures Commission utilized an uplift approach. This meant taking existing traditional license, such as Type 1 for dealing or Type 9 for asset management, and uplifting them by adding extra terms, conditions, and circular-based requirements specifically to cover VA activities. As the market matured, the regulatory approach evolved from these uplifts to dedicated statutory frameworks. These include using the Anti-Money Laundering and Counter-Terrorist Financing Ordinance (AML) as a basis for standalone licenses. This provides a more robust, legally defined structure for specific activities like fee custody, dealing, and advisory services. Before granting a license, regulators conduct a rigorous vetting process. They evaluate the management suitability, financial resources. Does the firm meet specific capital requirements and operational controls? The VA dealing license represents a critical evolution in Hong Kong's regulatory framework, shifting from an uplift approach, whereas traditional licenses were modified to a specialized standalone licensing regime. Here is a breakdown of what it means for the industry. This license is designed to capture a broad range of businesses that facilitate virtual asset transactions. It applies to spot exchanges, over-the-counter trading desks, brokerage services, and any entities acting as intermediaries that arrange virtual asset deals for clients. What is a new standalone regime? It is built on the familiar principles of Type 1 regulated activities under the Securities and Futures Ordinance. By mirroring these traditional concepts, regulators ensure that virtual asset dealers are held to the same high standards of market integrity as traditional securities brokers. Under this new framework, firms are required to move beyond classic oversight. They must satisfy stricter anti-money laundering, AML, and counter-terrorist financing CFT standards. A significant requirement of the license A significant requirement of this license is the mandatory use of SFC-regulated custodians based in Hong Kong to safeguard client assets. This policy aims to minimize the risks associated with overseas or unregulated third-party custody providers, creating a more localized and secure ecosystem. So it's basically just like the trading war is sort of a barrier, a trade barrier or protectionism policy. Just like the US or Taiwan, Hong Kong also limits or bans foreign exchanges into entering the Hong Kong market. So you may see that all those huge, large or famous exchanges like Binance or Coinbase, they do not seek the license in Hong Kong. Just like the Hong Kong exchanges, they will not be regulated in the foreign countries. Yesterday, we've heard that the head of virtual assets in HKMA, he talks about that the HKMA try to minimize the regulatory arbitrage, where people may take advantage of the difference in regulations across different jurisdictions, just like arbitraging between Kalshi and Poly market we do. However, the regulators also have to consider protectionism and I think the supply chain security. So it's a common approach, or it's quite normal that different countries ban the exchanges of other countries, and they will label foreign exchanges as unregulated. Many countries forbid foreign countries one another. So recently there are tariffs even between the United States and Canada. So it's quite common that laws or regulations nowadays have to consider protectionism. And I think that VA is also. Actually, we've understood 3 RWA or stablecoin related startups at the day when HKDAS launched this new paper. You may also take a look at these 3 startups, and they are quite interesting. One of it do some institutional stablecoin routing. I think it provides a protocol for sell side and also a Bloomer style terminal for the stablecoin buy side. Another one tokenize the revenues of vending machines and robotics. Unlike traditional credit systems, which you consider the ability of the borrowers whether he or she can pay the debt or not. This new model uses IoT to directly measures the credibility of the machines. So it basically monitor the cash flows of the machine and value how much financing is able to get, or how to price the machine, including traditional vending machines with stable revenue streams or some innovative robots. The recent developments with DeepSeek V4 Flash have been quite significant in the AI community. Initially, when DeepSeek V4 Flash was launched on the 1st of August, it experienced an explosive growth in usage, skyrocketing from processing 3 trillion tokens per day to 18 trillion tokens per day on OpenCode within just 2 weeks. This growth was driven by the model's competitive pricing and improved capabilities compared to previous versions, making it significantly cheaper than other models like Fable 5.6, so GB Soul's Sun and Luna. However, on the 16th of August, DeepSeek implemented a substantial price increase, 5 times higher during peak hours and 2.5 times higher during off-peak hours. This price hike drastically reduced the model's daily token usage to less than half of its peak volume. The sudden price increase was likely due to DeepSeek's inability to handle the massive surge in demand and rising GPU costs, which made it unsustainable to maintain the original low prices. DeepSeek V4 Flash pricing strategy involved using custom infrastructure to cache more tokens for extended periods, contributing to its affordability. However, with the price increase, there's now a significant gap of approximately 10 trillion tokens per day that needs to be filled by other providers. Despite efforts to find providers who can match DeepSeek's original pricing, the required capacity around 1,000 B300s to handle the throughput remains a challenge. This situation presents an opportunity for other model labs to step in and offer a model that is as competent and affordable as DeepSeek Flash. The demand for such a model is evident, and filling this gap could be beneficial for both providers and users. Additionally, within the GPT community, there have been reports of reduced usage limits for subscription plans. Some users experience significant consumption after running only one or two small tasks. Thibault, a representative from the community, clarified that affected users were sharing across multiple users, were primarily those using Sub2 API, a method of converting subscription credits into API traffic for sharing across multiple users. This usage pattern is flagged by fraud prevention systems, and users are advised to use their subscriptions through official channels like signing with ChatGPT or compatible OSS clients. In summary, the changes in DeepSeek V4 Flash pricing and the subsequent reduction in usage have created a void in the market, offering an opportunity for other models to capture demand. Meanwhile, users are encouraged to adhere to compliant usage methods to avoid disruptions in service. Over the past couple of years, OpenAI has discreetly developed Jalapeño, Jalapeño. And this Jalapeño is an inference chip that was recently unveiled at Hot Chips. There have been persistent speculation about a successful tape-out. However, detailed information is now available. OpenAI granted SemiAnalysis access to examine the chip, visit their laboratories to assess its authenticity, and evaluate using SemiAnalysis Inference benchmark suite. In June, OpenAI introduced the chip initiative in collaboration with Broadcom. Designed from scratch exclusively for LLM inference. Development commenced in mid-2024, progressing from initial team recruitment to manufacturing tape-out in roughly 60 months, which represents an exceptionally rapid ASIC development timeline. Typically, first-generation chips are not competitive, yet OpenAI deviates from this pattern by achieving industry-leading performance, surpassing every Nvidia, AMD, and Google chip that SemiAnalysis have tested across multiple leading open-source models. OpenAI accomplishes this through extensive hardware-software co-design. Interestingly, OpenAI does not over-specialize in any particular aspect of model inference. Instead, it focuses on creating a general-purpose chip that delivers high performance across all scenarios. Let's examine the architectural details, software aspects, and performance outcomes of Jalapeño on Inferencing. Contrary to common belief that OpenAI's chip is tailored specifically for OpenAI models, OpenAI has developed a generalized chip for AI inference. The development timelines are remarkably rapid. This demonstrates that assertions about AI accelerating chip design are indeed valid. Despite the quick timelines, OpenAI invested substantial resources, made pragmatic design choices, and assembled an exceptionally skilled team. So this outcome is unsurprising. Upon examining the specifications, it immediately emerges as a strong contender. Furthermore, its utilization of HBM4 distinguishes it as comparable to flagship GPUs from Nvidia and AMD. Much of the media coverage surrounding this chip has centered on a few brief comments from OpenAI claiming the chip would be optimized for their models in ways other chips are not. This assertion is incorrect. Jalapeno is a generalized inference chip capable of running a diverse range of models and workloads, including inference benchmark of semi-analysis, which semi-analysis is executed alongside OpenAI engineers in the laboratory. As a humorous demonstration, OpenAI even showed running Doom, which was ported to their chip using only codex prompts. The token throughput per all-in utility megawatt, there is the headline per performance per watt result. Jalapeno outperforms every other chip significantly. This is a chip without multi-token prediction (MTP), whereas the other chips in the chart represent the best performing configuration of each respective SKU, all employing MTP. So this Jalapeno does not employ multi-token prediction (MTP). Jalapeno surpasses Blackwell in per watt across nearly all scenarios without being optimized for any specific point on the curve. It performs exceptionally well not only in low latency situations but also in high throughput environments. A more direct comparison involves single token prediction results, where it decisively outperforms every competitor. At low concurrency levels, Jalapeno exhibits remarkably interactive, achieving over 700 tokens per second per user at concurrency 1 on the DeepSeek R1 model. Remarkably, this is accomplished with single token prediction (STP), without speculative decoding or preview decode disaggregation. In addition to DeepSeek R1, they also observe other models, including Kimi K2.5 and GPT-OSS, which operated at approximately 1,400 tokens per second per user. Across all models, they verified that Jalapeno's GSM8K evaluations produce results comparable to those of Nvidia chips. There are some snippets to consider. First, all figures were provided by OpenAI. SemiAnalysis personally verified the Inferencing runs in the laboratory, but they did not execute a complete set of Inferencing benchmarks, nor have they revealed AgentX results. AgentX is the preferred suite for comparing chip performance because its dataset features long context and multi-turn interactions. They reflect the cache behavior of realistic production workflows. Frameworks that perform well on HK1K may underperform on AgentX, as real production low-stress components such as routers, prefix cache mechanism, cache management, and offload infrastructure, which are not evaluated by single-turn AK1K. Second, semi-analysis contend that the comparison with Blackwell is somewhat incomplete and unfair. Jalapeno is actually competing against chips like Rubin, which also utilize HBM4. Fewer Rubin systems are currently beginning to ship to customers, whereas OpenAI will take some time before having anything beyond engineering samples of Jalapeno. Consequently, performance should be compared against Rubin rather than Blackwell, and to some extent, semi-analysis anticipate that a custom chip like Jalapeno will outperform Blackwell. Where Rubin NVL72 delivers 5.4 times the per megawatt of GB200 NVL72. As described in semi-analysis article analyzing Nvidia's performance chain claims from their launch with CoreWeave last month. Let me share the link to the article so that you may watch with us and you may read with us. Third, the model under evaluation are not at the open frontier. Nvidia and AMD have published results on larger models such as DeepSeek V4 Pro and Kimi K3 using AgentX. The larger and more recent the model, the more complex it is to bring up on a new chip. That said, the models OpenAI has operational on Jalapeño are not trivial in size either. OpenAI prioritizes perf per watt in its design. The rationale is straightforward. OpenAI is concurrently constrained by data center power rather than budget or floor space, making tokens per megawatt of paramount importance. At Computex 2026, Jensen Huang stated that perf per watt, reliability, and long lifetime are the core features of future GPUs. To quote, if you have 1 gigawatt of power, then throughput per watt is revenue. He also noted that selecting the wrong architecture merely because chips are cheaper is not sensible. This point was emphasized by Nvidia during the Vera presentation at HopChips 2026, while displaying the same revenue graph. The data center is power limited today. Power is a critical factor that drives revenue. Operators cannot simply acquire more megawatt because adding GPUs and expanding grid capacity occur on vastly different timescales. Data center power envelopes are subject to constraints such as utility interconnection, infrastructure, cooling capacity, and UPS or backup generation design. Grid delays consistently outpace hardware and construction timelines, driving the need for behind-the-meter BTM power capacity, which involves gas turbines and on-site generators built and located at the data center itself. This capacity operates behind the utilities meter rather than drawing from the public grid. It enables operators to power a facility without waiting for grid interconnection and utility upgrades, which is precisely why xAI's Colossus 2 relies heavily on BTM while its actual grid connection lags considerably behind. Additional information is available in the Power 2026, which we read in our previous reading Miscellaneous. It's about trading the electricity market. Token per second per megawatt simplifies to token per joule, since a watt is equivalent to a joule per second. This makes token per second per megawatt representative of a system's efficiency and its ability to convert energy into tokens. In this regard, even when compared with Ruben, Jalapeño emerges victorious. OpenAI's Jalapeño achieves STP output token throughput per megawatt that surpassed Rubin's MTP results published by Nvidia and CoreWeave in July. It also significantly exceeds GB200's 2025 MTP results. As mentioned in the Rubin article, VR was compared to 2025 GB200 results because that represented a similar early bring-up stage, and comparing to GB200 in 2025 keeps software maturity constant. Following this logic, we may compare Rubin's latest July 2026 results, GB200 2025 results, and today's Jalapeño results. This is a highly valid comparison, as these are the best public Ruby numbers, and OpenAI tapped out their chip after Ruby. Both OpenAI and Ruby are still immature, so performance will continue to improve. In terms of per TCO, Ruby and Jalapeno are closely matched, producing nearly identical numbers of OPO tokens per dollar. However, as previously noted, Jalapeno's results are achieved without speculative decoding, whereas Ferrobin's results utilize speculative decoding. Speculative decoding leads to an approximate 3 to 5 times reduction in cost per token. When speculative decoding is implemented on Jalapeno, it will enable even more cost-effective token serving. Of course, part of this TCO advantage stems from trading Nvidia's high margins, for Broadcom's lower, though still substantial margins. But this is not the sole factor. For instance, Meta and Microsoft's AI ASIC programs failing to gain traction. Failing to gain traction despite longer efforts demonstrates that cost is only one component of the equation. For a comprehensive TCO breakdown of Jalapeno, you may also refer to the SemiAnalysis AI Cloud TCO model. Architecturally, OpenAI chose not to disaggregate, preview, and decode TD across separate chip pools. The draft model and main model share the same chips and fabric, a design philosophy that creates some theoretical efficiency for practical operations. The motivation is that the workload mix evolves over time. For example, the ratio of input to cache write to cache read to open tokens has shifted significantly across the 3 areas of models: knowledge, reasoning, and agentic, as discussed in the previous article. Therefore, pre-allocating a fixed amount of heterogeneous preview and decode circle can lead to inefficiencies over time. OpenAI opts for a homogeneous pool in this architecture, striving to make the chip perform well across all tasks. And it does on Kimi K2.5, which underlies Cursor Composer 2.5. Jalapeno achieves nearly 700 tokens per second per user, more than 9 times the next best performing chip at 100 tokens per second per user. On GUD-OSS, it is another decisive victory. Jalapeno's ISO interactively throughput per megawatt is nearly double GB200's highest throughput point and more than 50 times GB200's concurrency. The higher concurrency Jalapeno points utilize EPA. These results are impressive, however, we must note a caveat. They are only 8K1K, a much easier workload to optimize for, and no AgentX runs have been conducted yet. As mentioned in our AgentX article, multi-run long context workloads stress many more aspects of the serving stack, such as routers and prefix cache. Numerous additional optimizations are required to excel in agent workloads. Further details are available in the AgentX article. This is more credible given that Jalapeno's TDP is only 700 watt, whereas Rubin's ranges from 900 to 1150 watt per compute there. Given that Jalapeno's is optimized for inference rather than training, it's reasonable that OpenAI does not need to elevate TDPs to maximize FLOPs. Nevertheless, the aforementioned data indicates that Jalapeno delivers respectable peak theoretical flops. When directly compared with other accelerators, Jalapeno exhibits the highest HBM bandwidth per watt and the highest flops per watt, on par with the 1800 Rubin Max Q configuration. OpenAI tapped out Jalapeno in November 2025. Or more precisely, this involved a tape-out of the COWOS design, not solely the top die circle. Within 9 months of that November 2025 tape-out, and with only 3 months of bring up on actual circle, OpenAI has already achieved very favorable results with Jalapeno. This is even more remarkable given that the team is beginning from scratch on the software stack. In the meantime, Rubin's COWOS tape-out was completed in October 2025, a month yet the only early results observed are from CoreWeave's engineering samples. Nvidia has not permitted us to test and release benchmarks in the manner that OpenAI has, suggesting that their chip software remains immature. The CUDA mode could potentially be obsolete given how rapidly OpenAI can bring up new models on their silicon. In the meanwhile, Rubin's COWOS tape-out was completed in October 2025, a month earlier, yet the only early results we have observed are from CoreWeave's engineered samples. Nvidia has not permitted us to test and release benchmarks in the manner that OpenAI has, suggesting that their chip software remains immature. The CUDA mode could potentially be obsolete, given how rapidly OpenAI can bring up new models on the circle. They are still far from optimized, and we can generally observe that Jalapeno has delivered superior numbers. SemiAnalysis does not believe that Nvidia hardware is inferior, but rather that Jalapeno's software will bring up has advanced more rapidly than mobile phone. When compared against Rubin's timeline, Jalapeno is remarkably rapid. As previously demonstrated, Jalapeno's results surpass Rubin's despite Rubin's hard head start. Now examining the architecture, the chip's matrix engine employs MXFP numeric formats and a weight stationary systolic array, similar to the TPU. However, when directly compared with the TPU, it supports smaller shapes and dimensions, meaning it avoids the peculiar performance cliffs that are exposed by awkwardly shaped modes on larger systolic arrays. It also features 64-bit scalar cores and FP32 or INT32 vector cores. OpenAI has additionally invested in redundancy at the tree level and has integrated yield harvesting at the core and channel level. They assert that AI assistance in chip design yielded an 8% reduction in SIMD area and a 10% reduction in matrix engine area during the design phase. Although they did not specify the exact process or voltage or temperature PVT conditions. They also noted that the AI-assisted blocks improved timing and power relative to the initial blocks. The Jalapeno's architecture design prioritizes eliminating memory movements of KYC cache and waste as well as fixed latencies and overheads to enable closer to raw peak flops or bandwidth even for small batches or shapes compared with other accelerators. The cores and HBM are partitioned into slices. The cores in HBM are partitioned into slices, with each core slice having a low latency local view of its own HBM slice. Synchronization between slices occurs over a high bandwidth dedicated collective network. This minimal memory hierarchy already provides Jalapeño with a significant potential advantage over GPUs, where memory access must traverse a complex memory system, resulting in larger latencies that must be amortized or hidden over large chips. This choice is feasible because with placement of weights and KVs, synchronization between cores can be restricted to limited non-high bandwidth communications such as tensor parallel communication that can be overtapped with compute. This is also an additional general NOC used for general communications and to access the scaled network. In general, OpenAI achieves substantial power savings and significant performance gains with a simplified NOC and memory system compared with Nvidia and Google or Mother Teresa. At the core level, OpenAI describes an out-of-order OO core with an L1 cache. This represents a significant departure from the pattern observed in other accelerations. The cores also support small matrix dimension, where depending on how small should enhance generality across different model and batch dimension, reducing sensitivity to matrix and edge chips have a very large systolic arrays that can necessitate large batches or exactly. Sorry for being sleepy. I didn't take enough sleep last night. The cores and HBM are partitioned into slices, with each core slice having a low latency local view of its own HBM slice. Synchronization between slices occurs over a high bandwidth dedicated collective network. The course also supports small matrix dimensions, which should enhance generality across different model and batch dimensions, reducing sensitivity to matrix dimension alignment, padding overhead, and tiling inefficiency. For instance, TPUs, Trainium, and Edge chips have very large systolic arrays that can necessitate large batches. Large batches are exactly divisible model dimensions to avoid tiling inefficiencies. With Jalapeno, OpenAI has concentrated on eliminating fixed latencies in the system to achieve as close to roofline performance as possible across all areas of the Pareto curve. In theory, this could provide advantages over the GPU at multiple operating points. Considerably better upper bound performance on low latency or small batch inference, which on GPUs is constrained by many fixed overheads such as launch latencies, battery latencies, and memory system latency. Some potential to get closer to the hardware roofline even for large batch or long context scenarios come with the that even if the upper bound performance is theoretically available, it may be more difficult to realize that performance for actual kernels. Thus, the approach appears to be designed for the highest upper bound performance across all workload shapes. Let codecs handle the tedious work of finding the kernels that achieve that upper bound. Give them the extremely rapid turnaround for the OpenAI team to bring up Inferencing workloads on Jalapeno. SemiAnalysis is optimistic about this approach. If Jalapeno proves successful, it will be a strong indication that the industry's obsession with programming models and perfect universal compilers is invalidated by frontier AI models. OpenAI writes Jalapeno kernels in a manner similar to Ensemble. Each kernel receives hand-tuned code, some extending to approximately 3,000 lines, supported by correctness checks and a custom sanitizer. Each kernel work was human in the loop rather than fully automated, but this shifted with a more scaled-up internal version of Codex, which OpenAI plans to offer to enterprise customers. The internal serving engine is referred to as Teacup. Interestingly, OpenAI had no internal implementation of MLA kernels until they benchmarked DeepSeek with Inferencing. The ability of Codex to write functional and efficient kernel so quickly without any intervention from OpenAI's kernel engineering team demonstrates the developmental capability of the software pipeline. OpenAI programs Jalapeno using Gluon. Gluon is OpenAI's kernel programming language. Built on top of Triton, Gluon preserves Triton's SPMD single program multiple data programmer model, but it exposes low-level programming abstractions. For example, for Nvidia GPUs, it offers API that map to PTX instructions, including MMA instructions, TMA instructions, and M-bearing mechanism, and many more. The most distinctive abstraction that Gluon provides is the layout. Generally speaking, a layout refines the mapping between a hardware resource, the fifth register of Rep9, and a tensor element. For example, a tensor element on row 6, column 7. Gluon's layout abstraction is based on linear layouts, a type of layout algebra that OpenAI invented. Linear layouts mathematically formalize what a layout is and provide tools for operating on layouts. This enables many features, such as provably correct layout conversions and optimal memory swizzling. In terms of Jalapeno's program model, each Gluon program maps to a persistent thread. SemiAnalysis believes this indicates that Jalapeno is suited to the persistent kernel programming pattern, where each program executes on multiple lines and the programmer rather than the hardware scheduler assigns the work. OpenAI mentioned TensorInfo, an abstraction that explicitly encodes layout. This is like the set of layout design for Jalapeno, which will be powered by linear layouts. Finally, each core offers data prefetching and decouple out-of-order units. For example, A user might program a weight on not behind a semaphore. In an ionic turn of events, OpenAI models such as GPT-5.6 Sol, which currently run on Nvidia GPUs, have been used to design a chip that poses a genuine threat to the CUDA. Most Nvidia's own GPUs are helping user in their potential successor in real time. A fungible fleet shifts capacity between latency-sensitive requests and throughput-oriented batches, while fixed-bit strands hardware whenever the traffic mix changes. Moreover, context length changes the balance between attention and FF and row, making any fixed hardware ratio efficient only near its design point. The same constraint applies to speculative decoding. A draft model must feed candidate tokens to verify with extremely low latency. Separating the two across specialized tools runs a lightly coupled decoding loop into a distributed protocol. The extra communication operation can consume the latency saved by drafting, keeping both models on the same devices, and low latency fabric preserves the locality that makes speculation worthwhile in the first place. However, disaggregation can still be advantageous where demand is sufficiently large, stable, and predictable, particularly when conventional GPUs need large phase-specific batches to achieve good throughput, but it's not a free lunch. From Japanese to Indian, mild to spicy, katsu, vindaloo, and shana. In terms of Jalapeno's programming tool and programming model, each gluon program maps to a persistent thread. SemiAnalysis believes this indicates that Jalapeno is suited to the persistent kernel mode programming pattern, where each program executes on multiple lines and the programmer rather than a hardware scheduler assigns the work. The OpenAI mentioned TensorFlow and abstraction that explicitly encodes layouts. This is likely the set of layouts designs for Jalapeno, which will be performed by linear layouts. Finally, each core offers data prefetching and decouple of other units. Comparing across time, we can also observe Jalapeno's developmental pace, achieving more than 2 times throughput improvements at certain interactivities in less than 2 weeks. Each table semi-analysis received from the Jalapeno team contains a world of wonders. Not only did kernel performance improve, but within 8 days, the Jalapeno team enabled TP32, building on the previous TP8 configurations and expanding beyond a single system to get a full rack-scale configuration running on a large model. This is a truly impressive pace of development. To validate performance before committing to real hardware runs, OpenAI also has a simulator called Inferencing that is accurate to within 5% of measured hardware using a fixed span of development. To validate performance before committing to real hardware runs, OpenAI also has a simulator called CUDA. Tracing on A0 was limited but what has improved substantially on B0, likely with inputs from actual runs on A0 silicon. Engineers have demonstrated the codec CLI running an internal model, nicknamed Raiku, or 5.3 codec spark at 1.2 millisecond TPOT. On the model side, OpenAI's internal mega-kernel approach, nicknamed Giga-kernel, is built around a single mega-kernel that loops on device to reduce CPU overhead and launch time. The team is also further exploring test time compute strategies, with internal interest specifically in how to coherently utilize 1 million rollouts. To dissect or not to dissect, that is the question. As mentioned earlier by SemiAnalysis, OpenAI is not using prefill decode disaggregation on these chips. This came as a surprise since Nvidia and AMD GPU performance benefits significantly from PDD. Even on homogeneous hardware, and let's examine why the Jalapeno team chose this path. Prefill decode disaggregation PDD appears attractive when the workload is frozen. Prefill and decode stress hardware differently. OpenAI is not using prefill decode disaggregation on these chips. This came as a surprise since Nvidia and AMD GPU performance benefits significantly from PDD, even on homogeneous hardware. Prefill decode disaggregation PDD appears attractive when the workload is frozen. Prefill and decode stress hardware differently. So assigning each phase to a separately tuned pool can improve efficiency at one chosen input or output ratio. Production traffic, however, does not remain speculative acceptance rates, and latency rate within a target are fluctuate throughout the day. Once devices are divided into prefill and decode pools, excessive prefill demands leaves decode chips idle while requests queue. But excessive decode demand does the opposite. The operator must continuously predict the correct split, provision spare capacity on both sides, and rebalance a system whose ideal ratio is always changing. In a unified system, some resources may be underutilized during a particular phase, but every device remains available to serve the next quest. In a disaggregated system, an entire chip can sit idle simply because it belongs to the wrong pool. Local utilization may look better, but global utilization can be poor. Disaggregation also breaks locality. The prefill worker produces a large KV cache that the decode worker immediately needs. So the system must transfer the state across the network before generation can continue. This adds bandwidth consumption, synchronization, queuing, and another failure domain. The cost also rises with input sequence length because the KV cache grows. However, avoiding the movement of KVs is largely a power and latency optimization. Being willing to move more KVs around can allow for increased hardware utilization at the expense of some power and per request latency. A fungible fleet shifts capacity between latency-sensitive request and throughput-oriented batches. The same constraint applies to speculative decoding. A draft model must feed candidate tokens to the verifier with extremely low latency. Separating the two across specialized pools turns a tightly coupled decoding loop into a distributed protocol. The extra communication and coordination can consume the latency saved by drafting. Keeping both models on the same devices and low latency preserves the locality that makes speculation worthwhile in the first place. However, disaggregation can still be advantageous where demand is sufficiently high, stable, and predictable. Particularly when conventional GPUs need large phase-specific batches to achieve good throughput, but it's not a free lunch. From Japanese to Indian cuts, and the Jalapeno system at the rack unit level comprises a CPU cost rack and an ASIC rack. The host rack, CPU host rack, contains 16 host GPU. Sixteen ASIC trays named Vindaloo, located to the right of the capsule. Each host accommodates two Turing-class AMD EPYC CPUs with 1.5 TB of DRAM, 2 times E1.S and 2 times M.2 SSDs per rack. Each tray is additionally equipped with 400 GB, that is 2 times 200 GB, for NDAC. The ASIC rack comprises 16 window trays and 8 scaled switch trays, 6 for local plus 2 for global designated channel. Each window tray contains 8 Jalapeno ASIC, resulting in a total of 128 Jalapeno ASICs per rack. The ASIC are linked to each of the channel which trays. Lower that traverse the rack horizontally at the front. The system level design is developed in collaboration with Stylistica. The ASIC rack comprises 16 window trays and 8 scaled switch trays, 6 for local, 2 for global, designated channel. In the local domain, each of the 128 Jalapeño chips has a per XPU unit directional bandwidth of 1.6 TB per second and is connected on an all-to-all basis to 6 times 102.4 TB per second Tomahawk 6 ASICs. This will amount to 48 different paired DP male and female connected pairs per XPU, translating to a total 4,144 DPs worth of passive copper cables per rack used for local scale. For the global domain, 16 racks totaling 2,048 XPUs are interconnected by a combination of copper backplane, electrical 204.8T TH6 switch, 1.6T transceivers, and optical circuit switch. Each XPU has a unit directional bandwidth of 1.6 TB per second for the global link. Since scale networking constitutes only about 10% of total system cost, that flexibility provides valuable optionality for future 10 to 20 trillion parameter models or 2.4 million token context windows. On deployment, OpenAI is partnering with neoclouds and is collecting reliable data with data center partners through January, optimizing clock-to-rack roll time. Since the cloud code milestone in November 2025, long context multi-turn agentic workloads have surged, now representing the majority of production inference traffic. By April 2026, OpenAI's enterprise agentic spending surpassed ChatGPT usage, marking a definitive shift in AI adoption. Agentic workflows have clearly become the standard. Today, SemiAnalysis launches AgentX, the world's first fully open source multi-turn agentic coding inference benchmark at 1 million context length, released under Apache 2.0. You may have heard that Apache also do the PHP for database management. The complete dashboard historically, performance measurement relied on fixed sequence preview and decode benchmarks, which failed to reflect real-world conditions. Actual production involves multi-turn interactions, extended context windows, high prefix reuse, sub-agent bursts, KV cache offloading, and frequent tool invocations. To address this gap, SemiAnalysis designed AgentX as the industry's most accurate framework for evaluating AI hardware and software performance. They invested over $3 million in developing this dataset and are now open sourcing all components. Inference X v3 integrates AgentX as a new realistic workload alongside traditional fixed-length scenarios, replacing simplistic single-turn patterns with authentic agentic coding traffic. The benchmark suite runs continuously on approximately 2 MW of compute power across more than 1,000 chips, including M355X, GB300 NVL72, GB200 NVL72, B300, B200, MI325, MI300X, H200, and RTX Pro servers, Rubin Systems will join the matrix later this month with TPUs and MI455X ULE72 arriving later in the year. Both Nvidia and AMD demonstrate strong performance on Agentic tasks. Nvidia excels across many frontier models, while AMD shows competitive results in specific model comparisons. The most significant outcome of AgentX early phase has not been performance ranking, with tangible impact across the ecosystem. Over 70 upstream pull requests in VLM, SGLang, TensorRT LLM, Atom Ultra, Dynamo, LM Cache, and Mooncake have used AgentX as a guiding benchmark. Most optimizations derived from these efforts directly improve real-world production systems. Open source is foundational to Inferencing. The implementation goes beyond rhetoric. SemiAnalysis provides an open front-end, a public database via a consumable REST API already used by multiple Tier 1 AI labs for capacity planning, public GitHub Actions CI pipelines, full logs, and accuracy validation for every data point. Critically, the configurations align with recipes. VLM.ai and SGLang cookbook using upstream images and sharing actual user experiences, not artificially optimized setups, are measured. An updated AgentX analysis will be published in 3 to 4 weeks, featuring additional workload optimizations and refresh performance data from AMD and Nvidia. Agentic workload profiles are evolving rapidly, and Inferencing remains committed to tracking them with speed and precision. Inferencing is fully open source, a mission made possible by their open source partners, including Infrared, VLM, Red Hat, LMND, Radix, SGLang, LM Cache, TensorMesh, Weka, Mooncake maintainers, AMD, Nvidia, Anthropic, and GitHub. SemiAnalysis also thanks Meta, Microsoft, Oracle, OpenAI, Minimax, Moonshot Kimi, Alibaba Q1, and Zhipu GLM for their support of the Inferencing initiative. Agentic workloads are defined by 4 core characteristics. Multi-turn. Sessions involves tens or hundreds of back and forth exchanges, far exceeding typical chatbot interactions. Long context. System forms 2 definitions and accumulated dialogue rapidly expand context length. High prefix reuse. As conversations progress linearly, raw outputs feed into subsequent turns, enabling extensive KV cache utilization. Cache efficiency improves as session length increases. Subagent burst. Sessions spawn short-lived subagents with fresh context, creating dynamic burst-C memory access patterns. These traits make agentic inference fundamentally a systems challenge, not just a compute problem, but high prefix reuse demands efficient cross-node rank KV tensor transfer via NIXL, MORIO, Mooncake. Optimal routing ensures request each nodes where relevant prefixes context string HBM capacity, necessitating intelligent KV offloading to a DRAM or SSD. Requiring robust solutions like Mooncake Store, LM Cache, VLM simple offloading, and SGLang high cache. This contrasts sharply with fixed sequence single-turn benchmarks, where prefix reuse is negligible and performance reflects raw chip or kernel throughput. That said, Inferencing's existing fixed length data remains variable. It isolates how low-level optimization progress and serves as a baseline for interpreting AgentX outcomes. To ensure realism, AgentX is built on 393 anonymized internal cloud code traces from SemiAnalysis. They preserve original prefix reuse patterns using a method inspired by Q1 Bayesian dataset. Traces are replayed via AI perf, simulating real request schedules under varying concurrency levels. 2 custom cloud code features were developed with Anthropic to enable this dataset Frontier AI labs, including OpenAI and XAI, evaluate inference performance through three core dimensions: cost-adjusted throughput (TPOT), time to first token (TTFT), and end-to-end task completion. Power efficiency per megawatt is also crucial and critical, as physical power availability, not capital, is the binding constraint in modern data centers, despite seemingly abundant funding. The data center model projects quarterly power demand and supply dynamics accordingly. Here, the report outlines key trends in agentic performance across leading models. SemiAnalysis encourages readers to independently validate findings using fully open source data, enabling transparent assessment of real-world inference capabilities. On single-node inference, MI's 355x performance under VLM lags behind AMD's proprietary Atom. While Atom demonstrates strong process, we urge AMD to prioritize upstreaming these optimizations into VLM for broader ecosystem impact. AMD's distributed inference DI team has advanced 8K1K scenarios over the past 6 months. Yet, DI remains suboptimal for real-world workloads. The 1xDPA plus 1xDPA disaggregated setup delivers marginal gains in high-throughput regimes, but underperforms in low-latency settings. Gains at mid to high interactivity are offset by sharp increases in P90 TTFT, driven partly by SG lengths enable preview the layer above concurrency 64, with layers prevailed to form fuller batches along SemiAnalysis introduces a new metric, E2E normalized interactivity, defined as OSL over E2EL. Since E2EL equals TTFT plus OSL times TPOT, the metric combines interactivity 1 over TPOT with a TTFT penalty term. This reflects user perceived responsiveness, penalizing high TTFT while rewarding sustained output speed. This metric is experimental. It over-penalizes TTFT and does not fully capture nuances like PD disaggregation. All AgentX v1.0 submissions optimize interactivity and TTFT independently. They continue refining holistic metrics to better represent modern agent inference trade-offs. The most significant early outcome of AgentX has not been the creation of open-source datasets, rather its tangible industry impact. Over 50 upstream pull requests from AgentX partners aim at optimizing real-world agentic workloads using AgentX as a guiding benchmark. AgentX evaluation framework goes beyond raw preview and decode kernels, measuring the full end-to-end token generation pipeline, including KV cache lifecycle management, hybrid attention kernels, CPU offload efficiency, data transfer progress, routing affinity, incremental tokenization, request serialization, and schedule overhead. Each component is critical in production-grade agentic system. This effort aligns with the broader mission to accelerate ecosystem-wide software advancements. A prime example is SemiAnalysis' SemiAnalysis multi-year collaboration with the AMD software team, where continuous feedback has helped modernize development practices. These contributions have driven meaningful improvements in AMD software velocity and brought their open source stack significantly closer to competitive performance on agentic workloads. Agentic inference is inherently systematic, extending far beyond chip or kernel design. In large-scale distributed environments handling hundreds of thousands of concurrent agent requests, efficient request scheduling and KV cache management become critical. Through optimizations such as resembling bursty KV cache patterns from subagents can lead to a premature eviction of main agent states, degrading performance. The architecture begins with routers or frontends directing incoming requests to appropriate workers. For instance, in their parallel attention setups, HTTP rank maintains a separate KV cache. To prevent cache thrashing, routing policies like consistent hashing ensures session or subagent AFIN requests are directed based on unique identifiers. While router implementations vary, some stand alone like VRM router, AMD router, others embed SGN model gateway, atom mesh. Their core logic remains largely consistent. Once route requests are processed by inference engines such as VRM or SGN, which execute inference and return results via API. These engines support pluggable interfaces connecting internal KV caches to external cache managers, enabling modular integration across components. In the current AgentX deployment, Mooncake operates along VRM on the same node. Each VRM worker embeds a Mooncake store client, contributing host DRAM to a shared external KV cache pool. Through the Mooncake store connector, reusable KV blocks are loaded into GPU memory, and new blocks are persisted to host memory. Mooncake store manages cache placement and eviction, while the Mooncake transfer engine handles physical data movement between memory tiers. Different KV cache managers may employ distinct transfer engines for moving data across memory or nodes, particularly between preview and decode stages. Mooncake transfer engine, for example, orchestrate transfers across GPU memory, host DRAM, and remote nodes. The node deployments can combine multiple strategies. Mooncake store offloads reusable KV blocks to host DRAM, while NIXL enables direct request-specific KV transfers from preview to decode GPUs. Mooncake TD manages one path, NIXL handles the other using UCX and GPU direct RDMA where available. Multiple paths thus coexist within a single engine. The ecosystem comprises independent modules, inference engines, routers, KV managers, transfer libraries, and cluster controllers. Platforms like Nvidia Dynamo, LMD, and AMD Infra integrate selected components into unified software distribution. They deliver compatible container images, connectors, deployment manifests, and orchestration logic, enabling seamless operation as coordinated system. The result is typically a set of K8s managed containers working in concert rather than a monolithic service. Long context workloads unlock parallelism opportunities that short fixed length ROMs cannot fully utilize. At 8K tokens, parallelization gains are limited due to minimal partitioning and already low time to first token. Traditional strategies like tensor parallelism and